Hello and welcome everyone to this webinar brought to you by Angels Den Funding and our friends at Crowdz. Thank you for taking your time out today, and hopefully you will have some strong takeaways from this session today, and we will be able to make this worth your time. I'm Abhilasha Dafria from the Angels Den Funding team, and with me is James and Steve from the Crowdz team. Hi guys.
Hello, great to be here.
Thanks for having us.
Would love a 10-second intro, both of you, before I take this forward.
Great.
Sure. I'll go first, James. I'm Steve Boderk. I'm the Vice President of Business Development and Sales. I've been at Crowdz for 3 years, and all of my background is in sales and business development, sold hardware, software, and the last few years in data analytics, which is very applicable to the Crowdz environment and what we're going to discuss today.
Excellent. Thanks, Bo. My name is James Kazanis. I've been at Crowdz for about a year, but worked previously with the guys for the year prior to that. My background's in banking and finance, and I'm very obsessive about digital assets and tokenization, and I'm looking forward to today's discussion. Thanks so much.
Lovely. So both Crowdz and Angels Den have come together to build Angels Den Finance, which has been helping hundreds of entrepreneurs across UK unlock the trapped cash in their unpaid invoices. And I would love to talk a lot more about that. But before we begin, let's start with a quick poll just to understand, what is the vibe in the community that has joined us right now, and what is your situation as entrepreneurs? So Sylvia, if you could have the first poll on the screen, please. What would you say is the most relevant new age debt instrument for new age entrepreneurs of today?
Yeah, another great question. So before I answer that, I'll tell you, it all changed in the 2000s, the birth of the internet. That changed really everything. And when I think about it personally, I think it comes down to information and the accessibility of information. So thinking about 2000 BC, where everything's being recorded on a clay tablet, there's not too much about the person you're transacting with or the counterparty. The birth of the internet changed that. Information became readily available. We started to have these digital footprints that would form with businesses and ourselves individually, and that made it a lot easier to kind of ascertain who we were doing business with and what the risks were. With that as well came really interesting and quite peculiar debt instruments. I think the most popular today, receivables finance, is actually probably the most popular. I think if you ask any general business person and any entrepreneur, it's typically an overdraft is what a bank would give you. It's just like that overdraft, and you can draw that up and down very freely. There's still very creative debt solutions out there. If you want to see how humans kind of make things more complicated than they need to be, look no further than 2007, 2008 in the GFC. Humans thought it'd be really clever to invent these things called CDOs and mortgage-backed securities, and they would essentially start taking things and bundling them together and insuring them and then overlaying them with derivatives. It got a bit crazy, but this is what we do as humans. Things become more complex with technology, but still today, the overdraft is probably the most regularly used financing line for people.
Right, got it. And let's maybe deep dive a little more on that. So you spoke about receivables, right? Let's talk a little more about receivables / invoice financing. And Bo, why don't you set the stage for us? So what is invoice financing and who is it for?
Yeah, so I can't spell Mesopotamia, and definitely clay tablets going to paper has been the mode over the last couple of centuries, and it still is today. Invoice financing purely is the ability to have a supplier, someone with an invoice that's selling to their end customer, a buyer, and having that invoice be of a term, 30, 45, 90 days, but not wanting to wait for that buyer to pay them so they can offer it up into a market such as invoice factoring, which is the most traditional market, or into a newer invoice financing market, which is what Crowdz supplies, and get that invoice financed at some level of discount, a small amount of discount, and then get their cash sooner so they can put it back to work either as raw materials for new production or payroll or whatever they need to do. Traditional factoring has been, very steep in the rates that are charged and exclusivity and other parameters. And why Crowdz came to be is we were trying to democratize this whole program and put in place a system that allowed people to invoice finance, on their own terms, in their own way, and whenever they need it.
And so if you could maybe just expand on that conversation a little more and talk about, what is the process? Can you just take us through the process of invoice financing, how this works, just maybe one simple user journey for our founders?
Sure, yeah. So Crowdz has two different models. We have our marketplace, which is our organic marketing, and that's been live since 2020. And the journey of an entrepreneur or a supplier coming onto the platform is very straightforward. There's a 10 to 15 minute registration where we do all the checks of KYC, KYB, and making sure that everything is set up and valid. There's inputs for financials to make sure that we have the construct of our risk scoring, which we call surf scoring. And that enables the funder, which is Crowdz in this case, to look at those invoices that are uploaded. So from an entrepreneur standpoint, it's a simple registration, uploading of invoice. They can connect their accounting platform if they desire. We have 8 connections: QuickBooks Online, Sage, Xero, MYOB in Australia. If they do that, they can move invoices across onto the platform easier. But once those invoices are uploaded and are deemed as eligible per the program, then all they have to do is accept the bid and get their invoices funded. The second half of that journey is once they receive payment back from their buyer, their end customer, they'll remit back the payments of that invoice financing back to the funder. And in this case, it would be Crowdz.
Right, great. All right, James, I'm going to come back to you at this point. Maybe you could touch upon the risks involved. Bo did speak a little about the surf score. Maybe you want to deep dive a little more in that. So who takes the credit risk? What if the end client defaults? What is all the scary thing that is associated with the term debt? Why don't you tell us a little more?
Yeah, absolutely. So with respect to counterparty risk and who's taking the risk, it's always depending on the type of facility. And with receivables finance, it's actually so interesting because there's different models that people run with receivables financing. So I'll give you a few different models, but mostly focus on what Crowdz do. We run what's called a true sale model. So when SME wants to sell their receivable for financing, they're technically selling that to the funder. So the risk then is on the funder, whoever that is. It could be an asset manager who's participating in the market. It could be a high net worth individual that is very familiar with the space. When they purchase that receivable and have thus funded the entrepreneur who sold it, they're taking on the risk. So now the funder needs the SME, or the entrepreneur rather, to collect on their accounts receivable, and upon collecting, pay that back. That's called the true sale model. If you look at receivables financing through a bank, they sometimes do things a little bit differently. They may take a portfolio approach where they look at an entrepreneur's full debtor book and then extend a percentage of financing to that book. Very similar to what you'd see with like a home loan, where they take a house and say, hey, we're going to give you 80%, you need to come up with 20% deposit. So it's done a little bit differently. And in those scenarios, the risk is then on actually the entrepreneur. They need to absolutely make sure that they're collecting their accounts receivable and paying back the bank. Typically, the bank will take security as well. So the risks really are that the entrepreneur has financed their accounts receivable, and then their buyer, who is the counterparty on that invoice, doesn't actually fulfill their obligations to pay them. And that's really where the main risk lies. We really like receivables finance for a few different benefits, but one main thing is it keeps the entrepreneur very focused on collecting in their accounts receivable. For a few of us who have been in business for a little bit, sometimes you get so caught up in running the operations of the business and doing the fun stuff in a business that you sometimes forget to do the boring things like the accounting and chasing up on unpaid accounts. And it can really get away from you. So we feel it forces a really healthy practice in business and managing your accounts receivable, because if you're working so hard and putting in all the hours to provide such a good service or product for your customers, they should pay you on time. You know, if they've said 30 days or 60 days, they should absolutely pay you at that time. Globally, the trends show that accounts receivables being pushed out. I think that's a function of inflation. That's a function of some economic challenges that have been brought on by COVID. So this is becoming a popular financing method, but it does keep an entrepreneur very focused on their receivables book and make sure they're collecting. And then you talked about a little bit about risk, and we've touched on the SURF score. I would love to dive into the SURF score because that's a common question that gets asked. What is the SURF score? How does it work? If I'm selling an invoice, what is it like? How do I get scored well? So think of Credit Karma. We've got Credit Karma in America, and you've got kind of Equifax that are globally. They produce personal credit scores for people. And as a consumer, you naturally go, well, how do you figure out my personal credit score? What makes me good or bad? And they're typically pulling data from phone bills, rates bills, council bills, your ability to service any obligation that you've entered into. The SURF score is kind of very similar, except we do it on both. We do it on a business lens. So the things that go into the SURF score, the first thing is very simply your standard KYC, KYB. So that's know your customer, know your business. And any business that wants to partake in financing needs to be registered with a corporate entity, et cetera, et cetera. Our tool will run database checks against those companies that offer that service, for example, like a Dun & Bradstreet and Experian, et cetera, et cetera. So once we confirm that the business is registered, this is where it's registered, it's got an active registration, we then pull in all the other bits of data that we can get. And it's from two sources. One is an external source, and there's 25 different external sources, and that's your Dun & Bradstreet and your Experian. These are all these databases. And then the internal source, which is an entrepreneur's financials. They can provide that information via upload on our platform, or they can do it in a very seamless way where they're simply connecting their accounting software, and via an API, it pulls out all that pertinent financial information into our modeling, and we run regression models on all of the data combined to generate a score out of 100. And we love this tool. It's very interesting. We're always working on it. It's something we're speaking to a lot of our customers who are also banks about, because banks have their own credit modeling as well, although they do it in a pretty traditional way. They collect financial information manually from customers, literally over email, send in your financials, here's a PDF, and they would typically have a credit analyst that goes over, they pore over all the information, and they may have some tooling where they determine the financial ratios, typically liquidity, debt serviceability, interest coverage, all these ratios depending on what industry, and they go, hey, you are credit worthy or you're not credit worthy. So think of that system, but our SURF score is leveraging modern day technology, APIs and databases to suck that in automatically and produce a score where we go, great, this is ready to go. For anyone looking to finance their receivables, the benefit for them is really seamless onboarding and quick access to finance. And lastly, we feel it's fair credit assessment. It's a really accurate credit assessment on where they are as a business, because I think sometimes in banks, it can be very subjective. Like, what if the credit analyst has a very strong opinion on a certain industry and they don't like it because they've had a bad experience? They're going to naturally have a bit more of a negative slant. Whereas we're looking mostly at the data, saying, no, what did the numbers tell us? Where is the projections at? Where are all these things at? So that's kind of how the SURF score works. And over time, the SURF score is in fact live. So as the entrepreneurs interact with our software and they're on our platform, if they're showing a really strong history of collecting and paying back funders, the score actually updates because it's collecting more internal data via API on that seller. They go, hey, this seller's like really onto it. They're performing, which can actually increase their score, among other things. So the SURF score is live. We love it. And we think it's a powerful tool, not only for us to determine the credit worthiness, but also for the entrepreneurs seeking finance.
Right, perfect. And maybe I would want to know a little more about what your customer profile is. I think I asked both this question, but we missed that bit. So, you've been seeing entrepreneurs every day, hundreds of them, and financing their invoices. Is there a pattern in the kind of companies, the kind of sectors, the kind of stages? What is your average ticket size? What is the default rate? If there's any information that you could give us that helps us self-screen.
Yeah, sure. First and foremost, there is no single market or single type of entrepreneur or supplier. I mean, really, there are industries that we will not entertain, and those are calculated in our scoring and the way that they're registered. But openly, we have service companies, we have product companies, recurring revenue companies, SaaS companies. So it's across the board, and industries and markets are also across the board. Finance, engineering, electronics. So we are very ubiquitous and open in that regard, which I think lends itself to an open platform and having the ability for anyone to really come to the platform, register, upload their invoices. Sizing is also across the board. On average, Crowdz has seen about $2,500 per invoice, but our ranges start from $250, and we've seen invoices up to $750,000 or $1 million. Our other white labels have seen higher ticket sizes, but traditionally, especially in the SME space, we see 1 to 5,000 as an average range of invoice sizing.
Got it. Brilliant. Maybe this is a good time for me to take some questions from the audiences. So if you have any questions to ask regarding invoice financing or anything about non-dilutive, please do type it in the little chat box, and I will take it up with the team here. And I also want to say that, from what I hear today and gather, I can conclude that debt as a form of finance in today's age and time has just become as risk-free and easier, in fact, and more founder-friendly than what equity or what traditional loans for the longest time were. And that is why we as a company that has been so much equity focused over the last decade and a half are now broadening our spectrum to incorporate, different types of debt instruments as well, because we think that so many companies come to us and each company has a different architecture, and sometimes just debt or invoice financing or a program like this would be so much more beneficial for you than mainstream equity funding. I think there needs to be a mindset shift, with the obsession of equity funding and move to more sustainable ways of building a business. I absolutely respect entrepreneurs who raise tons and tons of equity, but I equally celebrate bootstrapped founders. And so, if this is something that sort of rings a bell with you, then the Angels Den Finance program is something that you should definitely check out. I'll take the questions now.
Absolutely.
Sylvia, can you showcase the questions for me, please?
Yeah, I can also read them out loud.
Sure.
Okay, so the first question we have is, I have a new modular spectacle system for poor people across the world and have interest from SA, Pakistan, Bangladesh, Brazil, and Australia so far. I am ready to go into manufacturing for the proof of market trial. I have an offer of £2 million for pharmaceuticals company as a CSR. The second year sales are projected at £30 million at 60% profit. This could go global, and Innovate UK have indicated that they will support the expansion beyond the trial. Can you suggest any way I can source funding at the pharmaceutical company are not coming through at present? From John.
But do you want me to have a quick
Yeah, sure.
Yeah. So it's funny with a business like that, looking at funding, there's a few variables there, a few unknowns. It would be firstly looking at signed agreements. Are those agreements firmed up? Is there that, I think that the question said there was a signed agreement potentially. That to me, that's like a receivable, right? That could be a SaaS contract. Maybe it's being paid monthly. Technically, that could be finance. There are other factors in play. How much business history is there? The KYC, KYB. So for sure, debt can be looked at in that regard. Knowing that obviously we work with Angels Den and they provide financing across the full spectrum, equity and debt. If you look at crowdfunding platforms like Angel's Den. There's venture capital. There's various ways to finance that. It all comes down to that hard information around, are those agreements signed? What are the contractual obligations of those agreements? What are the exit clauses? These are typically the things that any funder would look at, whether it's debt or equity. But there's definitely a pathway there to financing, and it sounds like this particular individual has had tremendous traction. So congratulations on that. It's such a difficult thing starting a global business. So that sounds super exciting. Bo, I'm not sure if you want to add anything to that.
No, I agree. It's very exciting, and there's always the path forward is always ends with understanding the commitments and getting those invoices set out at the onset. There is one other area that down the road will entertain, like PO financing and SO financing, but at this point we're still just receivables in the form of invoices and recurring revenue. But yeah, congratulations on that work.
Right.
Great, Sylvia. Can we move to the next question then?
Yeah, so the next question is, I have products such as high purity alumina, which is a major substrate for sapphire growth and electric vehicle batteries. I need strategic partners to scale up production. What ways can we get investors to partner with my company?
Interesting. That's more of that's a very tricky one. I'll put my venture capital hat on for that question, if you don't mind, Abalaisha. Take my debt hat off, put the venture one on. So I think with that, when you're thinking about, and this sounds like probably an earlier stage business, perhaps, when you're trying to entice investors to come in, there's typically what I look at, and I was previously in venture, is a really well-organized data room that has all the pertinent information. So what does that mean? Okay, firstly, it's core materials like your pitch deck. What is your value proposition? How do you differentiate yourself from your competitors? You get that core story down, and then alongside that, you add a very intuitive model, financial model, that has all your inputs, your assumptions, with a lot of logic tied to it. And I'll tell you now, the market's very interesting. I think the pendulum has swung back in the favor of venture capitalists in this market, and they're now demanding businesses bring more fundamentals to the table versus probably a year ago, where they could come in, probably not focus too much on the fundamentals, but more on the story and still get financing. It's now very much down to, well, what will your EBITDA be? How does this impact cash flow? What are the cash flow drivers of your business? Because if you've got really good understanding and answers to those questions, the VCs on the other side of the table will be thinking, this person is thinking very logically and realistic about their business. It makes sense. One of the questions I have is, if we gave you the partnerships, how do you activate them? Do you have the resources to even activate that opportunity? That's a very common question entrepreneurs are getting asked today. Because sometimes you can land a huge partnership and you go, oh my God, I don't have the resources internally to actually activate that and extract what I need from that deal. So for me, it's getting back to fundamentals, a really strong set of core materials, pitch deck, model, any other information you think would help, and really getting your story down. I think that's a good way to entice investors from all areas. Hopefully that answers. Yep.
Great, Sylvia, shall we move to the next one then? If there's something more specific to debt or invoice financing, we'll probably take that first.
Yes. So there's a question that says, is the credit scoring also dependent on the end client's profile?
It is, yeah. So our risk scoring, the SURF score, actually scores 3 different entities: the supplier or the entrepreneur that registers, their end customer, the buyer or the obligor in this case, and also the receivable itself. That will become the more pervasive score over time, because if you take, for example, an entrepreneur registering having a 80 SURF score out of 100, and their buyer having a lower score, their receivable could have a score that might not be favorable for that specific event or that specific round of funding. But yet the next time, the end customer could change, having a better receivable score and having a better funding rate or a lower funding rate. So we do it on all three, and eventually it'll just come down to the receivable itself, the invoice itself, but bearing in mind that we factor in all of the attributes of the entrepreneur, the registrant, and also their end customer.
Perfect.
Okay.
That
We have
answers-
another.
Yeah, go on.
So another question says, "Hi, I'm Robert, CEO and founder to startup tech company. Where could it be? We're looking to starting our second raise, 10 million pounds, to move to new markets, North America, and springboard our platform quickly. Our invoices are paid automatically by our end users as we take their card details or via Apple Pay, etc. I'm not sure if this type of funding will work for us as we take payments fast, or is there other options without diluting shares?"
So if I understand, I'll may have to paraphrase a little bit. So the collection of monthly subscription, if it's a 1-year annual subscription and you're collecting monthly payments from Apple Pay or whoever it's coming in, that if there's a contract, we can actually finance that contract. That's called recurring revenue, and our platform goes live in about 4 to 5 weeks, and that could be integrated into the Angels Den Finance program. So yeah, the answer is yes, depending on if it's an annual contract and we look at all the attributes of those companies.
So how it works is that the total value, the annual value, will be given to you upfront at a discounted rate, right?
Correct. Yeah. And then we take over the payments, the monthly payments. So if it's $1,200 payments in an annual contract, they would get $1,200 minus the funding discount, and then we would collect those monthly payments over that annual contract term.
Got it. Perfect. And the SERF score would still apply. So the way of risking the credit profiles would still be the same.
Correct. Yep.
Right. Okay, great. That was a good question. Anything else, Sylvia?
Nothing too specific, but we have one that's just some other ones are just general questions about funding.
Sure, and we would love to answer them. So maybe, we'll reconnect offline and send out emails for anybody who has questions around equity funding. We're always here. And the EM team at Angels Den is always super responsive. So please feel free to reach out to us. But then if there aren't any more questions, maybe we'll just take some closing remarks from James and Steve. And before that, I just want to do a quick shout out to Sarah, Nina, and Sylvia, who have helped in setting up the webinar. Thank you guys for doing all the heavy lifting back end. And a big thank you to you, James and Steve, for that great conversation today. Would love to hear a little from you now, and we can then end the webinar today.
Excellent.
Yeah. Thanks very much. Go ahead, James.
Sorry, Bo and I do a lot of calls together. We're always doing this. From myself and Bo, obviously, thank you so much for having us. It's such a treat and a pleasure for us to come on and have a chat with you, Appalachia, and your audience. So thank you very much. We hope everyone got value from it. And I think my closing comments will be, there's so many awesome entrepreneurs that are really trying so hard to kind of get their businesses off the ground. And if they're out there with venture capitalists who are already forcing these entrepreneurs to focus back on the fundamentals of their business, that's a great habit, because when you look for debt financing, fundamentals are critical, so you're already getting into a really good spot to set yourself up for financing. And I'd really encourage debt financing where it makes sense over equity, because as an entrepreneur who's working so difficult, you don't get diluted so much. And dilution is definitely something that a lot of entrepreneurs are sensitive to, and so they should be, because at the end of the day, when they're working late nights, early mornings and stressing, they deserve the equity. They've fought hard for it. So we're always around to answer questions. If there's anything peculiar or tricky, we'll work very closely with Appalachia to kind of make sure you guys are looked after and you have some supporting resources, because we get it. It's very tough. So we're here for you, and thank you so much for your time.
Yeah. Awesome. Yeah. And thanks, Appalachia, for the opportunity as well. And I'll just add to what James said, it's doesn't take very long to register and get set up. And the nice part is you can trade your first invoice, you can finance your first invoice within 24 hours and get your money. And there's no commitment. So the commitment that you would see that money go to work for you may entice you to do more with us, and that we're here to help. All we want to do is put more cash onto your balance sheet and make sure that you grow and have the ability to keep doing this month over month, or every other month, or whatever the time cycle works for your business.
Perfect. And I second that, Steve and James, and this is coming from someone whose cash flow is heavily dependent on equity funding. So, I absolutely resonate with that point. And I think hybrid is literally the future of finance. So please take a look out for all potential finance options. And if there's something that you think would be more customized or specific to your particular startup, because we do understand each startup is unique, please, we would love to continue this dialogue offline. Feel free to reach out to us, and we'll do our best to support you in whatever way we can. Thank you so much, everyone, for joining. Thank you again, the entire team. Thank you, Steve. Thank you, James. And I look forward for this conversation to go on, and good luck.